Welcome to the deep dive. We cut through the noise to give you the core insights, the surprising facts, basically a shortcut to being well-informed.
And today we're looking at Arbe Robotics Ltd,
Right.
their Q2 2025 earnings.
Exactly. They're in that high-res radar space, automotive, other areas too. Our mission, as always, is to take this dense earnings report, use our 5-part framework, and, get beyond the simple headlines. Because you get these situations, right, where a company technically beats the estimates everyone's looking at.
Yeah, the consensus number.
But then the stock drops anyway. It can be confusing. So we're here to unpack exactly that kind of puzzle for you today with Arbe.
It's a classic scenario, especially for these early-stage tech companies like Arbe. The surface numbers don't always tell a whole story, do they?
Not at all. Our framework should help connect those dots.
Let's get into it.
Okay. So let's start peeling back that first layer. Now for slide 1, the at-a-glance scorecard. This gives us the headline performance for Q2 2025. And right away, it's a bit of a puzzle. Arbe reported revenue just under $300,000. It was actually $274,000.
Which is, well, pretty small.
It is, and it's down 33% from the same time last year, so definitely not showing growth on that top line.
Yeah, a big drop year over year. Not what you typically want to see in a company supposedly ramping up.
But then here's the twist. You look at the net loss, and it actually improved. They lost $10.2 million.
Which sounds like a lot, but it's better than before.
Right. It's down 13.5% from the $11.7 million loss last year. And even more striking, the diluted net loss per share. That improved a lot, too. Went from losing DSAR 19 cents a share to losing just Soroa 9 cents.
Okay, so revenue tanks, but the loss per share gets cut in half, more or less. How does that work?
Exactly. What is going on there?
Well, this is where understanding EPS earnings per share is super important. It's the profit or loss divided by the number of shares out there.
Okay.
Now, when a company's losing money, like Arbe is, seeing an improvement in that loss per share, especially the diluted number, isn't always about operations getting better.
So it's not necessarily good news.
Not necessarily operational good news, no. In Arbe's case, the main reason that loss per share looks numerically better is because the number of shares increased massively, like 74.8% more shares outstanding.
Wow, 75% more share.
Yeah, went from about 64 million to over 112 million shares.
So let me get this straight. They didn't lose less money overall in proportion to the share increase. They just spread the loss over way more shares.
That's it, exactly. It's an accounting thing called an anti-dilutive effect when you have a net loss. More shares make the loss per share seem smaller. And this huge share increase, it lines up perfectly with what we know about their recent fundraising, those cash infusions, adding up to nearly $70 million. That almost certainly involved issuing a lot of new stock.
So on dilution.
Right. And for you, the listener, the key takeaway is, don't just look at a headline EPS beat or improvement for an unprofitable company. You have to check if it's just dilution masking the real operational picture.
That's a really critical point. So the market, it seems, wasn't really swayed by these improved numbers. Because even though they technically beat consensus revenue of 0.274 Menners versus $0.27 as expected, and that adjusted loss per share of 6 cents beat the dollars or 8 or 10 estimates.
Right, they did technically beat those numbers.
The stock still dropped over 6.5% the day after the announcement. So what else was the market seeing?
Well, clearly the market looked past the accounting effects. They saw the dilution, sure. But also, Arbe did get a boost from $1.3 million in financial income this quarter, compared to expenses last year. That helped the overall GAAP net loss look a bit better.
Okay, so some non-operational income helped too.
Yeah, but analysts weren't convinced. TipRank's AI kept it neutral, citing significant financial challenges. Stock Titan called it negative, pointing to tiny revenue and big losses. Zacks had a hold. Yeah. So the market basically weighed the weak fundamentals, the dilution, the long road ahead, and said, yeah, those beats aren't enough.
Right. The bigger picture wasn't pretty, despite the headlines. Okay, that makes sense. Now, to really understand why that bigger picture looks challenging, let's dig into the actual operations. Moving to slide 2, the engine of profitability. Let's talk gross profit, or in this case, gross loss. Arbe reported losing $185,000 just on the cost of goods sold relative to revenue in Q2.
Which is worse than last year, right? They lost about $39,000 then.
Exactly, significantly worse. And that means their gross margin? Well, it collapsed. It went from about negative 9.5% last year to negative 67.5% this quarter.
Wow. Negative 67% gross margin. That's That's really bad.
It sounds pretty dire. What does that signal?
It's incredibly stark. It means for every dollar of product they sell, it's costing them about $1.67 decade just to make it or deliver it, before even considering R&D, sales, admin costs, everything else.
So they're losing money on every single sale, just fundamentally.
Fundamentally, yes. It screams early commercialization. High initial costs for manufacturing, maybe deals struck at low prices to get initial traction, R&D baked into cost of goods. It's just not sustainable long-term without massive, massive scaling or cost reduction. The fact it worsened suggests maybe pricing pressure or production getting even less efficient at this tiny scale.
That's a tough operational place to be, like digging a hole.
It is. Now, let's look at operating expenses, R&D, sales and marketing, general and admin. Total OPEX was $11.3 million.
Which is actually slightly down from last year's $11.6 million, right? Mostly lower stock compensation.
Correct. Slightly down in absolute terms, which on its own might seem okay, but when you compare it to their revenue.
Oh, boy.
Yeah. Those operating expenses were over 4,000% of revenue this quarter, 422% to be exact, up from around 2,800% last year.
4,000%. That number is just hard to wrap your head around. Spending vastly more than they bring in, and that ratio is getting worse.
Precisely. And this leads us to that GAAP versus non-GAAP thing again, specifically adjusted EBITDA. It's a measure lots of people use to gauge core operational cash flow.
Right. Strips out interest, taxes, depreciation, stock comp.
Exactly. And for Q2, Arbe's adjusted EBITDA loss was $8.9 million. Now, here's the key bit. That worsened from a $7.5 million loss last year.
Okay, wait. So the GAAP net loss improved slightly, but the adjusted EBITDA loss got worse.
Yes, because that $1.3 million in financial income that helped the GAAP number, that gets excluded from adjusted EBITDA. So this measure, which arguably gives a clearer view of the underlying operational cash burn,
shows things actually got worse operationally.
Correct. The cash burn from core operations intensified. Management even uses this adjusted EBITDA metric to figure out their cash needs.
Yeah.
So it's a really important signal that operationally, the cash outflow increased year over year, a very different picture for the GAAP net loss improvement.
That divergence is crucial. Shows you really need to look at multiple metrics to get the full story. Okay, now usually we'd break things down further. Now for slide 3. The engine room business segment performance. This is typically where we'd slice the pie, right? See how much revenue or profit comes from automotive versus, say, industrial or different product lines. It helps you see what's really working.
Yeah, you want to know where the actual traction is?
But looking through Arbe's Q2 press release, there's just, well, no breakdown like that. Nothing by segment.
That's interesting. So just a single top-line revenue number?
Pretty much. Management talks about making progress, qualitatively. They mention OEM engagements, data projects, moving into non-automotive like defense and smart infrastructure.
Yeah.
But no hard numbers attached to any of those specific areas in the release.
Okay. So for you, the investor, what does that lack of information mean?
Well, it makes it really hard to judge where the progress actually is, doesn't it? Are those non-automotive pushes gaining any real financial traction? Is one OEM deal driving most of the tiny revenue they have? You just can't tell from this report.
Exactly. It reduces transparency quite a bit. You're forced to rely on the overall aggregated numbers, which, as we've seen, can be misleading or hide important details. You can't pinpoint the real engine of potential future growth.
Yeah.
Especially for an early-stage company like Arbe. Understanding where the revenue is coming from and what the costs associated with that specific revenue are is pretty vital for judging if their strategy is working and where they're heading. It makes your job as an analyst or investor much tougher.
Definitely less visibility than you'd ideally want. You have to rely more on management's narrative without the segment data to back it up. All right, so given the operational burn and lack of segment detail, let's check their financial foundations. Let's turn to slide 4, financial strength and shareholder rewards. So looking at the balance sheet, there's actually some pretty positive news here. They reported $62 million in cash, equivalents, and bank deposits as of June 30th.
$62 million. Okay, that's a decent cushion, especially given the burn rate we just talked about.
It seems like a significant buffer, yeah. And maybe even more striking, their debt-to-equity ratio. It improved dramatically. It was around 1.36 back in December, and now it's down to about 0.16.
Wow, from 1.36 down to 0.16. That's a huge deleveraging. How do they manage that while still losing money operationally?
That's the key question, isn't it?
Well, it points directly back to what the report mentions, those recent cash infusions totaling nearly $70 million, that massive improvement in cash, and the drop in debt to equity. It's almost certainly because they raised a lot of capital.
Through selling more shares.
Primarily, yes. The source mentions over $30 million came from issuing ordinary shares. And it looks like they might have dealt with some convertible bonds too. That liability decreased significantly from over $30 million down to about $9.4 million. Maybe conversion, maybe repayment using the new cash.
So they tapped the capital market successfully.
Very successfully, it seems. And that influx of cash is absolutely crucial. It gives them that financial runway. Based on their current burn rate, that $62 million probably gives them around 2 years of breathing room.
2 years. That's vital if significant revenue really isn't expected until 2027, like they're saying.
Exactly. It allows them to keep the R&D going, push through those long OEM qualification cycles, and just survive until the market hopefully catches up or their design wins start generating real cash. It shows investors still believe in the long-term tech story, enough to fund it through this tough patch.
Makes sense. And any signs of shareholder rewards, dividends, buybacks with this new cash?
No, nothing mentioned in the release, and frankly, you wouldn't expect it. A company losing this much money focused purely on growth and R&D. Their priority is 100% reinvesting that capital back into the business to try and reach profitability down the road. Returning cash to shareholders isn't on the table right now.
Right. Survival and growth come first. Makes sense. Okay, that brings us to the final piece, looking ahead. Finally, we arrive at slide 5, the road ahead management's outlook and key takeaways. So what's management saying about the future? They're sticking to their guns, emphasizing that their radar tech is still a top priority for automakers.
They see the $70 million capital raise as proof of that, as strong investor confidence.
Right. They do acknowledge some bumps, though, short-term delays in automakers' rollout of advanced driver assistance systems, blaming, wider economic shifts.
Which kind of aligns with what we're hearing elsewhere in the auto tech space. Timelines are stretching.
Yeah. But they say Arbe is still moving through the request for, quote, the RFQ stages, and they're aiming for 4 OEM design wins in the next year.
Ambitious goal. 4 design wins would be significant.
For the full year 2025, they expect revenue between $2 and $5 million. Weighted towards the end of the year, they say. And adjusted EBITDA loss projected between $29 and $35 million for the year.
So revenue maybe picks up a bit from the Q2 run rate, but still very small overall, and the operational losses continue to be substantial.
Pretty much. The CEO, Kobi Marenko, also pointed to solid traction in non-automotive sectors, defense, smart roads, and reiterated that Arbe's tech is aimed at being a key enabler for those big volume 2028 vehicle platforms. But again, significant revenue growth really starts in 2027. It's a long game.
Okay, so pulling all of that together, the quarter's results, the balance sheet moves, the outlook, we can probably boil it down to 4 key takeaways for you, the listener.
Let's hear them.
First, continued early commercialization with strategic progress. Yes, Q2 revenue dropped, but they're making strategic moves, getting deeper into OEM selection processes, doing data projects, pushing into those non-auto markets. That groundwork is happening, even if the dollars aren't flowing yet.
Building blocks for the future, essentially.
Exactly. Second, persistent profitability challenges and increasing cash burn on an adjusted basis. We saw that clearly. The negative gross margin, the worsening adjusted EBITDA loss, it just highlights how much investment this takes and how far they are from profit.
Operationally,
They burn more cash.
no hiding from those numbers.
Third, and this is a big positive right now, strong financial runway secured by recent capital infusion. That year's $70 million raise is huge. It gives them that critical 2-year window to execute, navigate delays, and keep developing. It buys them time, which is essential.
Absolutely crucial, that runway.
Precisely. And fourth, market patience required as long-term potential meets short-term delays. The stock drop, even with the beats, tells you the market sees the long-term promise, but is weighing it against the reality of almost no revenue now, ongoing losses, and timelines stretching out to 2027, 2028. It's an investment that requires a lot of patience and belief in that distant future.
Yeah, it really sums up the tension, doesn't it? This deep dive into Arbe's Q2 really highlights that balancing act for these early commercialization companies. Declining revenue, some improved loss numbers due to dilution and financial items, but underlying operational burn and a market that's saying, show me more later.
It really does. And it leads to a fundamental question for you, the investor, doesn't it? How do you actually assign value to a company like this? You've got exciting technology, significant backing from investors who just put in $70 million. But profitability is years away, and right now, They'd literally spend more making their product than they sell it for.
It's the core challenge.
It is. It forces you to look beyond just the current numbers and really assess the credibility of that long-term strategic vision and their ability to execute on it over several years. It's not a simple calculation.
Indeed. Now, before we wrap up, the usual reminders. This report is for informational purposes only. It is definitely not financial, investment, legal, or tax advice.
Yep.
Always do your own research and consult with a qualified professional before making any investment decisions.
And also, please remember, this report was generated using an artificial intelligence model. It integrates data from Arbub's official press release and public market sources. While we strive for accuracy, you should always independently verify any financial data or calculations yourself before relying on them. Like and subscribe to stockanalytics.ai. YouTube channel. Members get access to our growing library of all S&P 500 stocks and get priority requests for company deep dives.